Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, this is Agostino. As your biggest partner on a deal, getting the right type of lender for your deal is absolutely key. Every lender has their own preference of deal size, complexity, and perceived level of risk. Well, today's guest spent more than 2 decades in the commercial lending business, and she knows the real estate game inside and out. In 2016, she led a launch of a company called Commercial Direct and works with investors to help them get their deals funded, landing financing in situations where a lot of banks just won't deliver. As a managing director of Commercial Direct, she and her team help others grow their real estate businesses and help them make significant gains to their portfolios. Now, with all that, I'd like to welcome Leslie Smith to the show. Hey, Leslie, thanks for coming on.
Hi, thank you for having me.
Yeah, it's going to be great. Well, before we go on, if you like what Leslie has to say, you can reach her via her website at commercialdirect.com. If you like our content, please don't forget to comment and rate the show. And finally, if you text the word freedom to 202-410-4202, you're going to get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Leslie, go ahead and tell the listeners about how you got started in all this lending stuff.
Sure. I mean, like most people, it wasn't a kind of a narrow road. It was a winding road that ended at this organization. I started in banking, very traditional kind of start, only, actually in call centers. And then there was an opportunity to go to a non-bank lender where, what was exciting about that opportunity was there was a lot less regulation, a lot quicker to, make change and, and actually lend. So I found that really exciting, and I've been here ever since.
One of the things we talked about in the green room was around the businesses or challenges around small business loan and small business lending, right? And I think many of our listeners would love to get a feel for some of the types of deals that you're funding, right? Especially on the small side, especially for people starting out as well.
Sure. Our lending box is, it's unique because when people speak about, small balance commercial, and we're talking about commercial loans that are secured by real estate, when I talk about I start at 100,000 to 2.5, most people are just like, really? Because, when they think about small balance commercial, most people think north of $1 million. Generally that's kind of, especially if you're talking about the multifamily space. And so my wheelhouse is loans from 100,000 to 2.5. We lend on very interesting property types. We lend to both investors and owner users. So if you're running your business in the real estate, we'll lend to you. And I think lastly, I would say that another piece why, makes us interesting is that most people can't get cash out of their commercial real estate. And that's, to me, really important because whether you're an investor or you're an owner user, that cash will help you, continue to either invest or invest into your own business. And so I think those are the areas that I think will make my business, pretty unique.
Right. So now, as far as someone starting off then, I mean, like we said, typically those smaller deals, they don't get funded by at least big commercial lenders anyway. So are you looking for the same sort of criteria, like DCR, that coverage ratio, all those sorts of things are just the same thing across the board? It's just smaller numbers, that's it? Or?
So a couple of things. So one, our general, due diligence and pricing starts with FICO. So we look at these loans as more kind of consumer. So okay. When you think about one of those, debt service is still a requirement, of course. But when you think about commercial, traditionally, they're non-recourse. And so typically the person's personal FICO score really doesn't matter, right. Or it's not taken into consideration, or it doesn't have a high, value in their overall due diligence. So we start with FICO, and then from there, your loan to value is driven by that FICO. But traditionally for us, we do still calculate a debt service. We have, and the way we underwrite, we can either do an underwrite straight on that cash flow of that property. We can do an underwrite based on 12 months of bank statements. We can do an underwrite based on your full tax returns. So it really depends on the scenario and really where this small business owner or investor is in their cycle.
Interesting. Yeah, because typically on larger deals, a lot of it is based off of the performance of the property itself, right? How much cash flow does it generate? Not so much on the investor well, not as much weighted as on the investor. I mean, they still look at the credit, they still pull all that, they still look at the score and all that jazz. They want to make sure they get paid back.
Sure.
That sounds a bit, that's always important, but it sounds like in your case, so what your guys are looking at is you guys heavily weigh more of the individual itself, right? Because it's like you said, a consumer loan. It's just, that's what it is, right?
I mean, think about it. Like my average loan size is about $425,000, so it feels more like a residential mortgage.
Right.
So therefore, when you think about, then going down to $120,000, you really want to understand, those businesses typically, especially on the owner user or even investors sometimes, their personal finances are not separate typically from their business finances. That's just kind of the space that we're in. When you're going north of $5 million, that's rare, where people commingle things.
Right.
And so for us in this space, the story matters, meaning the person that we're lending to, why they're with us, what do they need, how long have they been in business, and for us, it's interesting when we see someone that, they have 30 years of experience, they've made it to a couple of recessions, and they've been able to continue to run that business. To me, that's a really, when you're thinking about risk, that's really a great thing to see. And so those things, although those variables are important to us, but we found a systematic way of taking all those in and getting you a loan in less than 45 days. Because that's the other thing. These are small loans. People want their cash. And, when you're talking about loans in the 100,000, a lot of times people go to, some of the online lenders like Cabbage, and those are expensive loans because they need it quickly. So our goal is to get you in and get you out quickly, because it's a cheaper loan for me, and you get, as a borrower, get that cash that you need, or that, that refinance, because we do refinance folks out of pretty high interest rate loans.
Okay. Yeah. I mean, that's the thing though, too. It's like typically, especially for people that are starting out, maybe they got into a small deal, they got a hard money lender, and they're paying 10% or some other crazy amount of money just to get into the deal, just to bridge it. So then they can conceivably see you and get into a much better rate.
We're seeing those right now. Anything that was originated the first half of last year, all those people are coming back, and they're trying to find a way out of that double-digit interest rate for sure. And the ones that are not, like they're not being good business people, because they should be running somewhere to get a refi. Not me, somewhere. Please, try to get repositioned.
For sure. So now let's talk a little bit about that then. So as far as a typical smaller deal is concerned, I mean, on larger deals anyway, when I'm refining right now, I'm getting like under 4% IO, good amortization, long-term amortization. Like, is it similar sort of thing in your world too? Or like what sort of rates, what sort of terms are we looking at?
So let me just describe our typical borrower. Typically, our borrowers take a 30-year fixed or a 5-year fixed.
Okay.
And so they take a 30-year M. And our average LTV is about 65%. We do go up to 80% of LTV, loan to value. And typically rates are in the 6.5 to 7. And really the rate is really driven by your FICO, and then also what kind of documentation are you going to show me. If you're going to show me a full doc loan, you're going to show me your tax returns, then you can get down to 475. If the documentation is less and less, then I'm taking on more risk, then your interest rate will go higher. So that's typically what we do. On average, our debt service is about 1.3. So our customers are debt servicing, but our minimum is 1.15.
Right. Well, no, I always recommend to my students and people I speak to, 1.6 is probably where you want to end up. You don't want to go any lower than that, because ultimately, because if you're going to go that low to a 1.15 or 1.2, you're barely going to cover the note, and no profit left for you or your investors. That's a bad deal.
And that's, that decision is really based on, when we're talking about a borrower that's seasoned and has a really strong REO portfolio, those are the decisions where that person's like, I'm not going to max my leverage, and their LTVs, their debt service is north of 1.5. When you have a newer investor, they're still learning, you'll see, probably a higher leverage, and that debt service probably closer to the 1.15. Right. And so that's just honestly someone learning and figuring out what's best for them and where they are in the cycle. But those more experienced investors, you definitely, they're taking your advice.
Oh, so conceivably then, if somebody does have, like, say, a bunch of buildings or some single family, they're able to actually see you guys, and you guys will consider, oh, look, they have these, I don't know, 800 units or whatever, and they just refine this little deal over here because their typical giant lender won't do 100,000 or 200,000. So you're going to take that in consideration, right? But
Most definitely.
Historical, yeah.
Yeah, most definitely, because that to us is a clear sign that someone's really building a nest egg. They've done this before. They've done it successfully. And it's just sometimes, they're partners or they do have strong relationships, lending relationships, but they're just unwilling to do that $300,000 loan.
Right. And that's the thing. Yeah, exactly. I mean, many of the lenders I work with, they won't even touch like small $500,000 deals. They don't want to touch it. They don't want to do it.
Yeah, and for me, it's like that's why it's important to get in and out because it is costly. But I've built a business around where that's my focus. If you're talking to a shop that does $5, $10, $20 million loans, it's like they would have to really change how they make that loan. And the cost doesn't make sense to ratchet down to $1 million.
Right. Okay. So, well, good. All right. So given the loan size, all that, this is a full recourse loan, right? If something happens, your guys are going to go after them, basically. Yes. Good.
And we don't want to, and that's the thing. That's why we don't want to own the real estate, but we want to make sure that our assessment is about, can this person repay? The real estate is important because ultimately we may own it, but that's not, for us as a firm, like that personal recourse, we have it as a tool in our toolbox. But we would rather not. It's expensive to do that, to litigate that. So, I know some people are like, yeah, but you have that personal recourse. I'm like, yes, but it's expensive to get to it.
Right. Well, no, I mean, hey, listen, I even say the whole non-recourse thing, which typically our loans are non-recourse, but it's really just, how should I say, if I stop paying on any of my multi-million-dollar deals, someone is coming to my door.
Yeah.
Guaranteed. Someone who's going to be there. Someone will be there. They're going to be wondering, hey, what's going on? Right.
What's going on?
Yeah. What's going on? It isn't like you just get to walk away. It doesn't work that way. Right. So, I mean, the benefit though, it doesn't show up on your personal credit report. So I'm assuming that does this show up on your credit report then as well?
No,
or
it doesn't. Unless you default. Yes. But it's not something that shows up. Excellent. Yeah, because we have customers that do Fannie and Freddie, and they calculate that DTI, so we wouldn't want that to impact them overall.
Right. And that's important. That's important because especially if you have a bunch of these little loans and they total up to $1 million, they're going to see just a bunch of consumer loans hitting your credit report, and that's just very bad. What are some of the challenges that you're finding then for new people getting into commercial? Right, so. What are some of the things that you see for people that are starting out?
So one thing I do see is that, when you're a new investor, you have to really think about your roadmap. I think a lot of people, make some really bad decisions, and making a bad decision on real estate is really expensive when they don't necessarily they haven't learned enough about, what do I want to get out of this? What does this mean for my future? I think that's really important because then that sets your course about maybe even what kind of lender you would go to, what the deal should look like, short-term, long-term. I think that's one of the things that when I mentioned earlier that the story makes a difference to us, it does. And when someone doesn't necessarily have a plan, and I'm not talking about an official written down business plan, but just an understanding about this is the purpose of why I want to get into this. I think the other thing is, people in this space, documentation is not, and what I mean is by their business, their entity, do they have all the documentation that goes along with this entity that they want to close their loan on? I think that's really important because it really helps you get into that loan and get out of the loan more quickly. And also it allows us to understand who's involved. And it's messy in this space. I think the last thing I would say is people need to, especially when you're talking about investing, it's a marathon. It's not a sprint. I think really it's important for people to really think in those terms because, like I said, if you haven't taken the time to understand what your goals are, then how are you going to make good decisions about the properties that you're investing in? Right. So taking that time is really, really important.
Yeah, absolutely. I mean, this is not a get rich quick sort of business. It's get rich for sure if you do it right, but it takes time. Takes time.
But the thing is that, when you look at, there's so many like conferences now and like, blogs and so much about get rich quick with real estate.
Yeah.
And so I feel that that's like a lot of people come to us in that way, and it's not the case. Like we've seen people make some really big mistakes with this great nest egg that they're trying to build.
Yeah.
And it sucks that they're stuck with this piece of real estate and like, what do I do with it?
Yeah, exactly. No. I think that's the big gold rush with the air quotes.
Yeah.
The big gold rush.
Yes.
Everybody's like, hurry up, try to buy as much as you can, and don't worry about the repercussions. And yeah, I mean, and we actually do training as well. But what we do is we train for cash flow markets versus appreciation markets, and delineating between the two and buying the right deal for the right market, and for cash flow always. We just don't even pay attention to appreciation markets, just because they're all based on emotion and
definitely
and just irrational exuberance. That's it.
I think the other thing, I just thought about is like, also depending on their experience. A lot of people I see, they're investing in the single family market, and, they're expecting 100% back of whatever investment they made in the improvements of that property. And that never happens, not even in the best of markets. And again, that comes with experience. You dropped up, $100,000 to improve this property, you're not going to get that back 100%. And so that's another thing that people are challenged with, because they really are not making good decisions about how to improve that property and what really to spend on. So that's some of the stuff that we see.
Right. Well, speaking of that then, so are you also funding those types of deals as well, those fix and flips, that type of thing too, or?
No, because we're the type of lender that likes long term. So we're looking for folks that, that investment has already been made and the property is stabilized and the fixing's done. Okay. So we looked at it post-acquisition, post-fixing.
Okay, good. And now, do you have any markets that you guys love, or other ones that you avoid, or just anywhere across the board, or what?
So we lend nationally, and really we avoid, some of the more rural. So we don't lend like in North Dakota and South Dakota, but generally markets that we love, we love the Sun Belt right now is growing so much. Yeah. I think there's a lot of opportunity there, and I think prices are reasonable. We do a lot in the Northeast, but there's a lot of competition there, especially in the multifamily space. And then we love California, of course. There's a lot of opportunity, and then we're really interested in Tennessee and Arizona. So we're spending, really how do we get, especially in Tennessee, I think. Amazon and just the growth of Nashville over the last couple of years, makes sense for people to invest there. So that's kind of where we're focused this year.
Now, in some of these markets like California or in Seattle, many multifamily people, real estate people are like shying away from those states because of what's happening there as far as the landlord tenant type of scenarios are happening.
And New York too.
New York too. Yeah.
So in our space, like, the good multifamilies we don't see. Those guys are going to much larger commercial shops. What we see is a lot of the tier 2. And what I mean by that is like restaurants, bars, mixed use. So, grocery store at the bottom, 2 apartments on the top. We do like smaller strip malls where we have, a nail salon, a shoe repair place, and then maybe the owner owns the nail salon. So we kind of are in a market where, those kind of, we stay away from that kind of impact. We do a lot of what most banks, we do automotive, like, that most banks are like, no, we don't want anything to do with those property types. And so I think that in those markets, that's where we're strong. We know that, in Northern California and Southern California, we're not going to compete for some of the better multifamily properties.
Right. But like I said at the opening, you guys are doing deals that, or at least looking at them anyway, where a bank won't even touch them. Like you said, like if there's a automotive shop, most lenders, like your Huntington Bank up the street, won't even look at that.
No, they won't.
They won't even touch it.
We have the ability we have the experience to evaluate the environmental, we understand it, and so we're comfortable in that space. And so we build a business that we can execute on it. For banks, it's like, no, I don't even know where to start, and why bother?
Right. Excellent. So you've been in the business for a while. What are your general thoughts around the economic cycle? You see the rates are where they are today. They're the lowest they've ever been in decades. I think
Yeah.
ever. I think maybe even ever, right?
Ever. I mean,
ever.
ever. You know, when I started it here, you know, in this particular in 2004, like we were making loans north of 9%.
Yeah.
You know, at that point, right? So this to me is new, most definitely. We are cautiously looking at the market. We are, you know, paying attention as to what other lenders are doing very much. We are not the type of lender that just drops rates immediately. We hold typically and we watch. And we determine, like, and honestly, we've been watching it very closely since probably October, and we hadn't really touched our rates until this month, because we feel that it's been so cyclical that we've just been holding. But I think that this is an opportunity for people that really were, like we said earlier, that made their initial investment was in double digits to really get that cash flow back. And so, yes, it's a little expensive to get an appraisal and the due diligence, but frankly, they need to do the math because I think it's a really good opportunity for people to really get those investments back in line and grow that nest egg in a short amount of time. I think that we, from an investment perspective, we are slightly concerned about like how quickly people are changing their underwriting guidelines. And you're seeing a lot of like 90% LTV. Who cares about your credit score? Like we're seeing a lot more of that over the last 90 days, where people are
Really?
Yeah. And so, very kind of reminds me of like 2006, 2007. You know what I mean?
I remember that. That's exactly what's going on. Yes.
Yeah. And so I was there. I remember. And so when we think about product development and we think about risk, we are not going to be the ones going that way. I think there's a place where we can do really good deals and be reasonable and give good pricing and not necessarily, let go of our credit box or managing of our risk. So those are the type of things that we're very closely monitoring. But, we see a lot of our competitors really going the other way when it comes to really assessing risk.
Right. I mean, right now it's like, it seems to me like in the economic cycle, I don't know. It's a lot of it's driven by politics, right? So I think there's that too. But hopefully if everything stays fairly smooth for the next little while, anyway. So
I hope so. Yeah.
I don't know. What's your outlook as far as recession then? What are your general thoughts about that?
If it does, I think this coronavirus is probably going to have an impact as well. I think more of a panic. I didn't expect this to actually accelerate that. I think if anything, it will be, and this is me just guessing here, kind of my gut. I think if we would have one, it would be probably at the beginning of next year. I don't know if this virus will accelerate that.
Right. Hopefully by then it'll be gone.
Yeah.
That's right. So now what do you think that the next 5 years is going to look like for your business then? Like, what is your business going to look like long term?
So, it's interesting because I've been, although we're in 2020, I've been looking ahead at 2021, what does my business look in 2021? And I think it looks like relatively the same. I think that our product mix is not going to change very much because, like I mentioned earlier, we're kind of looking for long-term lending versus just short-term, make a bunch of money and move on. I think that I think I'll become much more efficient as a lender, and that's a really big part of my focus this year. How do I make double the volume with the same amount of people? Really critical when you're thinking about running a business that's doing $100,000 loans on commercial real estate. It's critical for me to have that cost to originate in a very reasonable at a very reasonable level. I don't think our borrower mix will change either. I think there are so many small business owners and investors that need financing that I think that'll be in a good place, especially when you're talking about some of these even the owner users that they had a food truck and all of a sudden they want to open a restaurant. Those guys really hard time getting a decent loan.
Yeah.
And so there's a lot of opportunity for me when it comes in the small business lending space.
No, I think it's great. No, I think the kind of stuff you guys are doing is awesome. You can help a lot of people, especially getting into some of the smaller deals. I mean, I'm often recommending get into big deals. However, you know what? Sometimes it's just tough to find, and you still want to get a deal. If there's a good deal, cash flowing deal out there, might as well get it, I suppose.
Yeah, we have a lot of doctors and chiropractors and lawyers that have been practicing in the building, that real estate for like 20 years, and then never even thought about purchasing the real estate. And I'm like, why? Why didn't you buy the real estate? Most of those people don't move. You have solid tenants. Within some of those. It blows my mind, but we see it all the time.
All right, guys. Well, if you want to reach out to Leslie, you can reach her via her company website at commercialdirect.com. Hope you got some good insight on lending. This is great stuff. Definitely reach out to her. Include a link to the website in the description. Thank you for your time. I greatly appreciate it.
Thank you for having me.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.